So, you want to buy a Taco Bell. Most people think that means writing a check for a franchise fee and putting your name over the door. Not quite. The real check is a lot bigger, and a surprising amount of what happens next isn't actually up to you. By the end of this video, you'll know exactly what it costs to open your own Taco Bell right now, how the company that owns it collects money from you whether you're profitable or not, why your franchise agreement doesn't actually protect you from competing with yourself, and what happened the one time a contamination scare hit every single Taco Bell in the country at once. Let's start with the number everyone gets wrong. The Taco Bell franchise fee itself is only $25,000 to $45,000. That's the cheap part, the fee that technically buys you the right to use the name, the logo, and the recipes. The real number is what it costs to actually build and open the restaurant. For a new freestanding location with a drive-thru, Taco Bell's own disclosure documents put total investment at $935,000 to as much as $4.3 million, depending on the market and the format. Buying an existing location instead of building new is cheaper, but still runs $175,000 to roughly $1.4 million. On top of that, Taco Bell requires franchisees to show a net worth of at least $1.5 million and liquid assets of $750,000. And for larger deals, requirements can run as high as $5 million net worth and $2 million in liquidity. This isn't a side hustle business. Taco Bell was founded by Glenn Bell in Downey, California in 1962, sold to PepsiCo in 1978, and spun off along with KFC and Pizza Hut into what became Yum Brands in 1997. Today it runs close to 8,000 US locations, roughly 90% of them franchised, with an average unit volume of about $2.24 million a year as of the end of 2025, and the brand is still growing. Taco Bell opened 159 net new US locations in 2025 alone, and reported an 8% increase in same-store sales in the first quarter of 2026, a growth rate most fast food chains would kill for right now. Part of that comes from menu innovation. The Doritos Locos Taco alone sold nearly 1 billion units in its first year in 2012, one of the most successful product launches in restaurant history. Part of it is automation. Taco Bell has been publicly testing AI-powered drive-through ordering across hundreds of locations, aiming to cut labor costs and speed up the line during peak hours, a shift every new franchisee is now effectively required to build around. Here's where it gets interesting. Once you're open, Taco Bell collects two ongoing fees regardless of whether you're making a profit that month: a royalty of 5.5% of your gross sales, and a marketing fund contribution of 4.25% of gross sales, pooled with every other franchisee's contribution to pay for the national ad campaigns. That's nearly 10% of every dollar that crosses your counter, gone before you've paid a single employee, before you've paid rent, before you've bought a pound of beef. On top of that sits a technology fee, roughly $750 a year per restaurant, just for the point-of-sale system, plus 19 cents on every digital order. A cost that keeps climbing as more of Taco Bell's sales move to the app and the drive-through kiosk. None of this is unusual for a major franchise, but it means the corporate parent gets paid first, gets paid every single period, and gets paid the same percentage whether your location is thriving or barely covering its lease. Now here's the part most new franchisees don't fully absorb until it happens to them. Taco Bell's franchise agreement does not grant territorial protection. Nothing stops the company, or another one of its own franchisees, from opening a second Taco Bell close enough to compete directly with yours. In November 2023, a franchisee running the Taco Bell inside Indianapolis's Circle Center Mall sued Taco Bell's corporate franchisor and a fellow operator, Flynn Restaurant Group, the largest franchise operator in the country, to try to block a new Taco Bell cantina from opening across the street, roughly 1/10 of a mile away. The lawsuit argued this violated Indiana's Deceptive Franchise Practices Act. It didn't stop the opening. The cantina opened anyway. It's a clean illustration of something baked directly into the contract. You're not just competing with other brands, you can end up competing with yourself, and the franchisor has no obligation to stop it. There's a second layer worth knowing before you sign anything. Increasingly, the biggest Taco Bell franchisees aren't individual owner-operators at all. They're massive multi-brand operators like Flynn Restaurant Group, the company on the other side of that Indianapolis lawsuit, running Taco Bell, Pizza Hut, Wendy's, Applebee's, Arby's, and Panera locations, generating roughly $4.5 billion in combined annual revenue. When a new prospective franchisee applies today, they're not just competing against other small operators for territory and financing. They're competing in a system increasingly dominated by private equity-backed consolidators who can absorb a bad quarter or a bad lawsuit in a way a single restaurant owner simply can't. The Indianapolis dispute shows how a franchisee can be undercut by decisions made above their head. The 2006 E. coli outbreak shows how the whole system can get hit by something that's not really Taco Bell's fault at all, and every single franchisee pays for it anyway. In December 2006, health officials linked an E. coli outbreak sickening dozens of people across 5 northeastern states to Taco Bell restaurants, eventually tracing the contamination to lettuce from a shared supplier. Taco Bell voluntarily pulled green onions and then lettuce from thousands of restaurants nationwide and switched suppliers within days. It didn't matter that a single franchisee in Pennsylvania or New Jersey had done nothing wrong. Yum Brands reported Taco Bell's same-store sales fell 5% in the fourth quarter of 2006 as the news broke, then plunged 11% the following quarter, with the slump lingering into late 2007. Every franchisee in the system, thousands of them who had never touched the contaminated produce, absorbed a share of that decline because the brand and the supply chain are shared, even though the businesses are individually owned. Yum Brands' own quarterly filings kept citing adverse publicity related to a produce sourcing issue as a drag on results well into 2007, long after the outbreak was traced and contained. It's a useful reminder of what franchising actually is underneath the marketing. You own the 4 walls and the payroll, but you don't own the supply chain, the recipe, or the news cycle, and all 3 of those can turn against you on the same afternoon. So let's put it together. 2 realistic paths into ownership right now. Option 1, buy an existing, already profitable Taco Bell instead of building new. That puts your total investment somewhere in the $575,000 to $1.4 million range. At the system average unit volume of roughly $2.24 million a year, you would hand over close to $220,000 combined in royalty and ad fund payments before counting a single other expense. After food costs, typically 28 to 30% of sales, labor, rent, insurance, and everything else that keeps a quick service restaurant running, a well-run location can realistically clear somewhere in the range of 10 to 15% of sales as pre-tax operating profit. Roughly $225,000 to $335,000 a year on that same average volume store. It's a real return, but an active one. You are running a restaurant 7 days a week under an operating system, an inspection schedule, and a fee structure that does not bend just because your month was slow. Financing helps close the gap. Yum runs a minority assistance program that guarantees 25% of a qualifying franchisee's loan principal, up to $3 million. But qualifying for that program still requires clearing the same net worth and liquidity bar as everyone else. Option 2, build new construction in a strong market instead. The $2 to $4.3 million end of the investment range, typically with a drive-through and Taco Bell's newer 4-lane Defy design built for pure digital and delivery throughput. You're paying more upfront and waiting longer to break even, but you're also building the asset that tends to hold or increase in resale value the most, since a modern, well-located restaurant with a drive-through is exactly what a future buyer, or Taco Bell itself, wants to acquire down the line. It's also the format the brand is actively pushing its newest franchisees toward, which means better site selection support and marketing attention, but also the highest exposure if a downturn, a supply chain scare, or a competing location 2 blocks away shows up before you've paid down the debt. Either way, you're not really buying a taco stand. You're buying a seat inside a system where the parent company gets paid the same cut, whether you're having your best month ever or your worst. Where a competitor with the exact same logo can open across the street from you legally, and where the fine print never actually promised you'd be the only Taco Bell in the neighborhood. Compare that to Chick-fil-A, famous for a $10,000 franchise fee because the company itself owns the real estate and equipment, then takes 15% of gross sales plus half of the profit in return. Or McDonald's, where the total investment runs $1 to $2.3 million, and the company owns much of the real estate outright, collecting rent worth 8 to 15% of gross sales on top of its royalty. Every major franchise structure asks the same underlying question in a different way. How much of the upside do you get to keep, in exchange for how much of the downside you're required to absorb? At Taco Bell, the answer is written into a 5.5% royalty, a 4.25% ad fund, and a contract that never once mentions the word exclusive.